Hello my dear traders, Panda is here, and today we're gonna trade with my trading robot. And now my question to you: how did a deal that followed all the rules turn out to be a failure? It seemed like everything was right, the correct trend, the right candlesticks, a proper pullback from the trend line, and guess what? A loss, a failure. And today we will break down how this happened and how emotions play a role in trading. And I already opened first deal, which is gonna be on the currency pair British pound to United States dollar, and my trading bot has indicated the priority of the movement for buy, and the probability is 73%. And alright, let's get back to my question, and answer is gonna be here in this video. This is the reality, guys, of trading that everyone faces, whether we like it or not. I've never met a trader who's never made a mistake. Such heroes don't exist and never will. The problem isn't that we lose money. Everyone does. The real question is how to cope with it and find the strength to keep doing. How do you handle this kind of stress? After all, losing money isn't easy. We come to trading to make money, but many end up losing it at first. So how do we deal with it? Stress builds up, negative thoughts fill your head, and frustration from losses spills over to your family and friends. So how do you deal with this emotional slump? Traders' emotions. First, you need to realize that our brain acts differently under stress compared to normal situations. When it comes to our money, we see things differently that we would in ordinary circumstances. And that's absolutely true. And to handle this split between logic and emotion, you need to put in real effort. One of the simplest ways to become a disciplined trader is to focus on a specific decision before opening a deal. Why is this such an important thing? Because before you open a deal, your logic isn't yet clouded by emotions and works as it should. But once you are in deal, everything changes. You start thinking about fear of losing money, greed, and uncertainty. That's why you should plan everything before you open a deal. Then all you need to do is calmly wait for the result. And everything should be prepared before you press the button. The three pillars of discipline are: first one, trading plan; next goes money management; the last one, risk management. Yeah, just these three. All trading books and biographies out there boil down to these core ideas. The plan's job is simple. Know what to do, why, when, and how much. The plan reflects everything: your personality, expectation from trades, risk, and money management, not to mention your trading system. Trading without a plan is like relying on luck. You wouldn't want to gamble with fate, right? Fate is very unpredictable. A trading plan helps eliminate impulsive trades made based on your emotions, which happen when you open positions randomly. The best way to avoid this is to reduce your risk by having a plan that covers specific market movements. And this way, you won't have to rush or panic. What's in the plan is what you trade, and there is no need to worry. Then we go to difference between a trading plan and a trading system. A trading system is detailed description of the reasons for opening deals. It's part of your trading plan alongside market analysis, risk, and money management. Since market conditions constantly change, a trading plan often includes multiple trading systems. We will discuss systems later, but for now, just remember that trading plan is a broad structure and a trading system is just a part of it. And now we are very close to, yes, finally closed our deal with my trading bot, because my trading bot never loses and gives only profitable signals. And now let's find our second deal, which is gonna be British pound to Japanese yen currency pair. We're choosing 5 minutes expiration time, run analyze, sale. The probability of leaving for sale is 76%, trusting my trading bot. And now the conditions for my contest, guys. If you wanna win $50 from Panda Trader, you just need to like this video and leave any comment under this video. One person can leave up to 5 comments. And now we are moving to money management. The simplest rule of money management: how do you protect your money? And here is the rule. The maximum amount for a deal should be less than 5% of your total balance. I emphasize that 5% is the maximum amount you should risk. If you are working conservatively, it can be even less. We can say 1 or 2%. As a general rule, the bigger your balance is, the smaller the percentage should be to avoid the psychological impact of risking large amounts of money. For example, you have 5,000. If you lose $250 out of 5,000, you have $4,750 left. And you take 5% of that again, which gives you 237. And if you lose, subtract that, and so on. Then we go to flexible money management. This is a type of fixed money management. You work within strict limits up to 5% of your total balance, and within this range of 0.1% to 5%, you can adjust based on the market situation. This approach is more psychologically flexible, and it's the only one I personally use. Let's say your confidence in deal is low. You don't want to miss the opportunity, but you are unsure of the outcome. Why risk more than 1% of your balance? And you don't. You could risk even less, maybe 0.5% if your balance allows you to do that. On the other hand, if the chart shows a setup that has historically worked well, like a familiar pattern at a support or resistance zone, for example, then you can risk up to 5%. This flexible system is recommended for experienced traders who already have a good understanding of what they are doing. Then we go to money management violation. It's incredibly hard for a beginner to follow a simple rule. Risk no more than 5% of their capital. And often, without realizing it, they break this rule right away. How? Let's take, for example, a minimum deposit of $10, and the minimum deal amount is $1. What percentage is $1 of $10? Exactly, a 10% risk of your deposit. So just because of the small deposit size, you immediately violate money management, unfortunately. And that's why there are minimum deposit requirements for traders. It's easy to calculate them. For example, if you want to work conservatively and risk only 1% of your deposit, then the minimum deposit for a $1 deal should be $100. To risk 5%, the minimum deposit for a $1 trade would be $20. And who can break money management rules? Actually, a professional. But even for them, there should be a strict upper limit that they never go beyond no matter what. For me, that limit is 10% of the deposit. There are times when the market looks very tempting and the chances of success seem extremely high. If I feel confident, I might risk 8 to 10% of my deposit, but never more than that. And such ideal situation happens much less often than I would like. If you go beyond a 10% trade risk, it just shows that greed has taken over and you are heading toward failure. And only after losing several deposits do you realize that money management and managing psychological risks is the only way to keep your money safe. The only one way. No strategy or pattern will help you if you break money management rules and risk more than you should. A professional trader is different from a beginner because they strictly follow money management. And a beginner tries to win back losses and may risk 50 or even 100% of their deposit right from the start. This will only lead to losing the deposit and losing confidence. So the sooner you learn to stick to money management, the sooner you will reach the stage where your deposit isn't drained, and then you can focus on growing it. And that's gonna be it, guys, for today. Thank you for watching. Panda Trader was with you. I wanna remind you one more time to join my free Telegram channel where I give profitable signals every day. And of course, you can try my trading bot. You will find the link in the description of this video. Like this video, subscribe to my channel. All the best, guys. Good luck.